All right. Hello, everyone. Happy to have you here in this video. We're going to talk about the life insurance module. I'm going to make it as understandable as possible. And in these few hours, and the different parts of this video, I won't be able to cover the entire 300 pages, but I'm going to cover at least 80% of it. And it's the most important part of it as well. The most important thing is actually to understand what the whole concept is talking about because it's going to be based on cases, and you have to understand the logic so you can answer the questions. But sometimes you really do need to search a book for some definitions as well. So I'm definitely sure that this video is going to help everybody with understanding the material and being ready to become successful as well in the exams. Now, the first topic that we want to talk about is actually an interesting one. And I'm going to ask this question of how to avoid the risk of getting into a car accident. So there is a risk that if I'm driving, I might fall into an accident. And there's a couple of things that I can do to reduce or minimize the risk of getting into a car accident. Let's talk about a couple. Drive slow and carefully, choose the best route, be fresh and awake, check the weather, have a reliable car with more safety options. All of these bullet points that I just mentioned are the ways that I can minimize the amount of risk that I have when I'm actually driving. Now, there are some people that they're totally careless. They don't care about the weather. They don't care if they're, completely hygiene or, awake and fresh. They don't care if they've been drinking or not. They don't drive carefully. They don't look into the car, and the maintenance of it, and they just drive it. They don't check their tires and all of that. So basically, they don't do anything. They just take all the risk, right? And we've seen both sides of people in our lives as well. Some people that are really, you know, uh, careful and they minimize the risk, and some people that they're completely careless. But there's another thing that we can do to minimize this risk to actually zero, right? And have no risk of being involved in a car accident. And that is don't drive. If I don't drive, there's not going to be any accident that I'm going to at least be at fault, right? Or if I don't commute with a car, I'm not going to be involved in a car accident. These are the different approaches that we have. And this is the introduction of talking about how we manage risk. So risk management is in four ways. The first way is called risk avoidance. That would be exactly this one. Don't drive, right? If I don't drive, I'm avoiding that risk 100%. It's not going to happen. But some people, as we talked about it, they're careless. And those are the ones that their risk management is risk retention. They don't do anything, they don't care. And the ones that actually care and they minimize the risk, they're following an approach or a management called risk reduction. So these are the first three types of risk management: risk avoidance, risk retention, and risk reduction. Now, let's say if the total amount of risk that we had is this amount, all right, just as an example. And then if somebody is careless, basically they're having this amount of risk. If somebody is minimizing the risk, they are taking less risk, right? Because their car is, sustainable and it's been checked. The weather is good. They're fresh and awake. So the amount of risk of getting into an accident for them is much lower. But there is still some part of risk remaining. You can be the most careful person and the most careful driver, but eventually there is a 100% that I always say, a cow might come and hit you. So it's really important that we understand this, that we can never bring the risk to zero if we are going to do that. And for that, there is the fourth way of managing risk, which we call risk transfer. So risk transfer means that I am going to be, whatever this amount is, transferring it to somebody or something else that they will take the risk for me. And that is what the real definition of insurance is. So as an insurance advisor, you have to know what insurance means. Yes, it protects us. Yes, it does this, it does that. We all have an idea about what exactly insurance is. But the real true definition of insurance is transferring the risk to somebody or something else. Now let's look at it. If this is person A that is careless and this is person B that is actually careful and has a risk reduction management in his driving, and basically Person A is a person with risk retention management. They don't really care. What will happen if both of these people are going to go get car insurance? Well, the car insurance company is going to see that person B is transferring way less risk compared to person A. So obviously, if the car insurance company sees that the person A is transferring a lot of risk to them, they might even not be willing to transfer that risk, or they're going to charge you more. And that is why our car insurance price and premiums are based on our history of driving as well, because it's about the amount of risk that you are posing to the insurance company. Now, let's talk about why life insurance. Remember, in life, we don't have the risk avoidance because when we're born, and the risk of dying is there. So there's no risk avoidance that we can have. But obviously, there's a lot of people that they don't really care about their lifestyle, about their mental or physical health, about where they work, about what dangerous things they do, about how many times they drink or smoke in a week, how they drive, with who they actually, surround themselves and who are their friends, who are their inner circle people. And all of that would be risk retention. And there are some people that they actually exercise, they do workouts, they work on their, mental health as well. They're passionate, they have good people around them, they're careful about what they eat and where they go and all of that stuff. And that's a risk reduction management. But again, there's going to be that part of risk, just like person B, that needs to transfer it to another place or someone else, which would be the insurance company. So why do we need life insurance? It is because of the risk of loss of income, right? So sometimes it's about I'm going to lose my income if I pass away, or loss of caregiver. So maybe that person is not actually generating money, but they're saving a lot of money by taking care of, the household. Debt payment. If I owe somebody money and I don't have the opportunity to pay them back, that is going to be a problem. Business protection, our estate, taxes, education funds for our children. These are all the risks that we are taking if we pass away. And as much as we want to take care of ourselves, there is still that, slight and slim chance that we might pass away sooner than when we expected. And for that, we need to transfer that risk to the insurance company. Let's look at an example, actually. So in this question, it's saying both of Leona's parents and grandparents have type 2 diabetes. Since Leona's risk of developing the condition is quite high, she tries to lessen its probability by following a sugar-free diet and exercising regularly. Being aware of the complications, Leona also purchases a life insurance policy as she has two young children. Which of the following risk management strategies is Leona taking? So Leona has her parents and grandparents all diagnosed with type 2 diabetes. So she knows that in her genes, there is a risk of developing this condition as well. So what is she doing? First of all, she's taking a sugar-free diet and exercising regularly. This is obviously a risk reduction strategy in management. But she still knows that, there is being aware of the complications. She also purchases a life insurance policy as well. So she's transferring the rest of the risk to the insurance company. So in this case, the two strategies that Leona is using for her managing risks are risk reduction and risk transfer. Let's go to another question. Sachin is a sales executive who earns a gross monthly income of $6,200. His employer deducts the following amounts from his pay: $295 for employment insurance and CPP, $180 for his group disability coverage, $290 for the company pension plan, and $1,300 for income taxes. Sachin's wife is employed, and if Sachin dies prematurely, his family will need 50% of his income to maintain their current lifestyle. On what annual income should Sachin's insurance needs analysis be based on while determining the coverage needed? So basically, the gross income is $6,200. There are these deductions that come out of that gross income to give us the net income that Sachin actually brings home. And the family will need 50% of his income if Sachin passes away. So they need 50% of what Sachin actually brings home, right? So for that, if we want to understand in the financial needs analysis or the insurance needs analysis, how much money does the family need if Sachin passes away? We first have to calculate the net income, and after that, we're going to calculate 50% of it, right? So let's do that on our calculator with 6,200 minus 295 minus 180, 290, and $1,300 of tax, which that would be $4,135. That is what he brings home. Now, they need 50% of that. So what is that going to look like? It is going to look like as $2,067.50. But we're going to look at it on an annual income. So we have to multiply this by 12 to get the final answer. And the final answer is going to be 24,810. Now that we understood what insurance is, and it's basically transferring the risk to somebody or someone else. And we did talk about it, that if there is a person A with this amount of risk of dying, and then there's person B with this amount of risk dying, obviously they shouldn't be paying the same premiums. And it's not fair, and it's not right as well. So we can all agree that the premiums are calculated based on the mortality risk, the risk of dying. Now, right now, person A has a higher risk of dying, so their premium is going to be higher as well. Person A has a lower risk of dying, and for that, obviously, the premiums are going to be lower. Now, when we're talking about the factors, the indicators that are going to be calculated in determining what the premiums are going to cost, what are they? Age is really important. As you get older, the risk of dying is higher as well. Gender, so men tend to die sooner than women. Smoking, drinking, any health condition, any family history, just like that question that we had that, the family, the parents and grandparents had diabetes. Occupation, what is your job? There's a difference between a truck driver, somebody that's sitting in the office, and somebody that is, cleaning windows of high rises. And leisure, maybe somebody's only, hobby is to play PlayStation, but somebody else likes to go scuba diving. Obviously, there's going to be a difference in the risks as well. Now, whatever these are, eventually, they're going to give you a rate. So for instance, for person A, they are going to say, hey, if you want $1,000 of coverage, and this is exactly how they rate the premiums. If you want $1,000 coverage, it is going to be, let's say, for instance, $10 a year. And for person B, if you want $1,000, it is going to be $6 a year. All right. So what happened here? They would always calculate the cost of insurance based on $1,000 in a year. So right now, person A has to pay $10 for every $1,000 of life insurance he needs or she needs, and person B would have to pay $6 for every $1,000. And it makes sense because obviously person A is transferring more risk. And then we will multiply that by the death benefit amount. So let's say if both of them want to have $500,000 of life coverage. So how much money should A pay a year? Obviously, it's going to be 10 multiplied 500 because every $1,000 is $10. So we want to have 500 of $1,000. So this person has to pay $5,000 a year to have $500,000 of coverage. And for person B, it is going to be $6 multiplied how many? Again, 500. So that would be $3,000 a year that they have to pay. So a couple of things over here. Insurance rates are always annually. They're based on a year, right? What if they want to transfer it and pay monthly? This is where a really important concept comes up called modal factor. So the modal factor is the conversion rate between paying annually or monthly. And we're going to talk about what type of insurances do have a modal factor, which means that it's going to be more expensive to pay monthly, and what insurances actually don't have a modal factor, which means that there's no difference if you pay annually or monthly. But if there is a life insurance policy or any other type of insurance that has a modal factor, basically that modal factor is going to be a rate, right? Let's say for A and B, this rate is going to be 0.08, or maybe just make sure if I get this right, because I always have the wrong calculation over here. So it's going to be 0.08, let's say 0.09. All right. Let's say this is the modal factor rate. So right now, for person A, if they want to pay monthly, this is how the formula works. So they have to pay $5,000 a year. What we're going to do is we're going to do the $5,000, so the annual rate, multiply the modal factor. And this modal factor, let's say it's 9%. So in this case, this is going to give us 450. This 450 means how much you have to pay in a month. Now, if you multiply this 450 into 12, that is going to give you $5,400. So you see, if this person pays annually, they're only going to pay $5,000. But if they pay monthly, it's going to actually become $5,400 in a year. Same thing for person B. So $3,000 multiplied 0.09, how much is that going to be? 207 a month. So this is what they have to pay monthly if they decide to pay monthly. And if we multiply it by 12, we're looking at $3,240. So again, they're paying $240 more than what the annual amount, which is $3,000. So this is what the modal factor is. Not all insurance policies and types of insurances have a modal factor, but most of them do. All right. Now, let's go back to person A and person B, and let's talk about that risk that they're possessing to the insurance company, right? We kind of got a sense that for any reason, the rates of the person B to get insurance, their premium rates are going to be higher. Now, let's say if person B is a completely normal person, no major health conditions, not smoking, not drinking too much, occupation is, normal, not really crazy leisure stuff, everything is kind of normal, right? What we call their rating is standard rates. So standard rates are when everything is normal. There's nothing really to be concerning. And based on, your age and your gender, and again, the questions that you answer, you will get a standard rate. Now, let's say if there is another person, and this is person C, all right? Person C is actually having the same amount of risk transferring just as person B. They're both in the same way. But there is one difference. Person C loves to do bungee jumping, a really dangerous sport. And if that person, is doing that, what does that mean? There is one factor that is skyrocketing the risk. So person C, without bungee jumping, is exactly like person B in terms of the risk. But because he does bungee jumping, this is the real risk that he's taking. So the insurance company thinks to himself that, okay, this doesn't make sense to me, that I want to cover person C when there's a high chance that they might die because of their, bungee jumping habit. Or let's say if somebody has a really dangerous occupation, like a police officer or a firefighter, right? They would say, okay, well, he has a normal life. He's pretty good in everything, but what if he passes away due to his job? So in this case, we have a standard rate with exclusion, which means that the insurance company will say, hey, I am only going to cover you for everything except this bungee jumping or that leisure that you do. So I'm going to cover you exactly normal with the same rate. So if person B is paying $200 a month, person C is paying $200 a month as well. So the rates are the same, everything is the same, except the exclusion of that leisure or that occupation. Make sense? But let's talk about person A. Person A smokes and actually has diabetes as well. And because of that, you can't really say, hey, person A, I'm going to cover you exactly like person B and person C, but I'm going to exclude the factor that if you die because of smoking. We actually can't exclude that smoking part because the smoking could actually affect our heart, our lungs, our throat, everything. Or diabetes. You can't, again, differentiate how diabetes is going to harm your body. Or family history. There's nothing that I can exclude. So in these cases, their rates are going to be higher. So maybe it's going to be $400 a month, for instance. And that's what we call the rated rate. So the elements of mortality risk that are not exclusive, you can't just differentiate it. That is where the rates are going to get higher. But if it's something that you can exclude it, just like, a leisure or occupation, you would actually be able to exclude it and the rates are going to stay standard. But they will not be covered if they pass away because of that leisure. And then preferred rates are for athletes. We don't really get into it because athletes, they have different types of body, style and BMI and all of that. So they have and then they have their own risks as well. So it's kind of something different. It could be cheaper, it could be more expensive. So this is what mortality risk is. This is how premiums are calculated. And these are the different types of rates that we have. I hope that this visual pictures with my wonderful drawing could actually help you guys to understand it better. Now, when we're talking about insurance and all of that, there's always different needs, right? Remember in the first slide that we talked about it, it could be loss of income, it could be education funds, it could be funeral expenses. So there's different types of needs that we have or risks that we have that we want to take insurance. And some of them, they're actually temporary. What does that mean? That means that this need or that risk is not going to stay with us for the entire life. What are some examples? Loan. If I have a loan, well, I have to pay back the loan in a certain amount of time, like a mortgage, right? I have to pay it back in 20 or 25 years. So I know that I have a risk that if in the next 20 to 25 years I pass away, I need to repay that loan or that mortgage. But after that, I don't have that loan. So I don't have that risk. Or children education. I say my child is right now 2 years old. So I might need to cover, their education for another 18 years or another 16 years. But I know after that, I don't have that yet. Children dependency. They're going to be in my home maybe until age 20, 22. And after that, they're on their own. But until age 20, 22 of their life, I'm responsible for it. Or spousal support as well. So let's say if you're divorced, there might be spousal support that you have to um, pay them and support them until the age of 65 of your spouse. So for all of these, that I actually have an expiry date for my needs. I have an expiry date for my risks. We would recommend a term insurance. So a term insurance is a temporary insurance, and it's really useful if I have a short-term risk. The risk is decreasing, like a mortgage. Every year I'm paying off the mortgage, so there's a less amount that I owe to the bank. Or sometimes it's increasing. Let's say if I have a business, and I know that every year my business is growing, so I'm going to have more liabilities. Or sometimes it's actually not about the temporary need that I have, but it's about the limited cash flow and budget that I have. I'm not in a financial, circumstance that I can actually pay for a permanent insurance. So I at least will get term insurance. And term insurances, they come in different lengths. So it could be a T10, which means it's for 10 years. It could be a T20 for 20 years. It could be a T30 for 30 years, or it could be a T65, which means until age 65. Or we have a T75, which means until age 75. All right. So don't get them mixed up. Don't think it's a 65-year term. It's actually mean whatever age you are, you're covered until age 65. Now, coverages tend to be in two ways for insurance, right? We've talked about it in understanding insurance. We're going to talk a little bit more about it right now. You can have a single life insurance policy, and this is not just specifically for term insurance. I know I put it here, but it's for any type of insurance. Or you might have a joint life insurance policy, which means that two insureds are in this policy. And they come in two ways, either joint first to die or joint last to die. So joint first to die is the type that between the two insured people, the first one passes away, the second one will get the money and the death. But in the joint last to die, both insurers have to pass away until the money goes to a beneficiary. What are the reasons why some people get a first to die joint policy? One of them might be mortgage. They say, hey, we're a couple. We want to make sure if one of us passes away, the other one has enough money to take care of the mortgage and pay it off. Or a joint last to die might be for legacy or funeral expenses or taxes or whatever there is. And they might think about getting a joint last to die insurance policy. So these are the two types of joint life insurance policies that we have. Let's dig in more into the term insurance. Term insurance can have three different types of death benefit in terms of their amount. It could be level, increasing, or decreasing. What does that mean? Let's say if it's a T20, all right? From year 0 to year 20 that we're insuring that person, it might be level. What does that mean? Let's say if it's a $500,000 of life insurance from the beginning, whenever they pass away in this 20 years, there's a $500,000 death. But in an increasing life insurance policy, it might gradually increase in terms of the benefit amount. Let's say every year for $10,000. That means that by end of the term, that client actually, or that person, has $700,000 of life insurance because every year they're getting $10,000 added to their insurance policy. And there might be sometimes that we have a decreasing life insurance policy, which means that, let's say, for example, every year, again, $10,000 is being reduced from the death benefit. So depending on when that person dies in that 20-year time frame, they will get a different amount of life insurance. This will go down to $300,000. So obviously, if I'm getting an increasing death benefit amount of insurance, I would have to be paying more as well. Why? Because I'm getting more insurance and more coverage. If I'm getting a decreasing life insurance, and it might be really good for mortgage. Why? Because we talked about it. A mortgage insurance, income replacement, let's say until age 65, children dependency, children education. Every year that goes by, my risks of having that need is going to be lower as well. My children are going to grow. I'm getting closer to retirement, or my mortgage is being paid off. So in that case, what we have to do is we have to make sure that if there is a decreasing death benefit option, we choose that one because it's going to be cheaper in terms of the cost. So this is what we mean by the types of death benefit amount: increasing, level, and decreasing. And obviously increasing is going to be more expensive. Then we have different term insurances based on whether we're able to renew them or not. All right? We have a non-renewable one. What does that mean? And this is a really important section. I want you guys all to pay great attention to it. A non-renewable policy means that, again, by the end of the term, the policy is done. All right? So let's say a person purchases a life insurance at age 830, and it's a term 20. So in this case, at age 50, they're done. They don't have any insurance. If they pass away 1 hour after age 50, and after that 20-year term, they're not covered anymore. So some people will get a renewable policy. A renewable policy will guarantee you to be renewed. And you're able to renew your policy without any medical insurability. So even let's say at age 45, for instance, this person gets diagnosed with cancer, but because they had a renewable policy, they can still renew it for another 20 years. But if that person only had a non-renewable policy, what would happen? At age 50, they have to apply for another new insurance policy, and they might get declined because of their cancer. So because a renewable policy is guaranteeing you for a longer time frame, or potentially a longer time frame, the price is going to be different as well. Let's say in the non-renewable one, the client is only paying $30 a month, but in the renewable one, the client is paying $40 a month because of that guarantee. Wherever you're putting more risk on the table, obviously the insurance company is going to charge you more. You are giving that risk to the insurance company that maybe by age 60, I'm going to have a serious health condition or something is going to change in my life. So the insurance company is going to charge you more. A good thing about it is that it's guaranteed in terms of the rates. So you know that at age 50, you are going to be paying, let's say, for instance, $300 a month because it's going to be based on your age. It's called the attained age. So we have an original age, which is the age that we actually purchased the policy. In this case, it would be age 30. And then we have the attained age, if I spelled it right, which would be any time that I renewed it. Okay. So that would be age 50. So they will tell you that, okay, medical, we're not considering it. We'll consider you exactly with the same medical conditions that you had at age 30, but your price is going to be based on your age at 50. And it's going to be $300 a month. So you know from day one, from age 30, that, okay, I'm going to pay $40 a month right now, but I have that guarantee that if I want to renew it, I can renew it with $300. Now, this is the most important part. When you renew it, let's say at age 51, the client decides to commit suicide. What will happen? We know that we have a 2-year suicide clause or a 2-year incontestability clause as well. But because this is a renewable policy, it doesn't have that 2-year suicide clause anymore. Because the 2-year suicide clause was right at the beginning and it's over. So if this client actually commits suicide at age 51, the insurance company has to pay it. But let's say this person that actually purchased the renewable policy and was paying $40 a month until age 50 talks with their insurance advisor, and the insurance advisor suggests that, hey, why don't you go and apply for a new insurance policy? Go get a new term 20. Why would an insurance advisor recommend that when this person already has a renewable policy and they can renew it for $300 a month? Because there is a possibility that this person is actually still in a really good health. And there's a possibility that if they reapply for a new insurance, they're going to get a better rate. So maybe if they get a better rate, maybe it's going to be $250 a month. So now the insurance advisor is saying, well, you know what? I know that you paid $40 a month till now to have that guarantee insurance, but luckily, thankfully, your health is still good, and you actually would be covered for the same insurance policy that you had without any exclusions, without any rating. It's going to be $250 a month. Let's do that one. So in this case, what's going to happen? They're going to surrender the policy that they have, and they're going to get the new one. And that is where there's a couple of things that's really important. We've talked about it before. LIRD, Life Insurance Replacement Declaration. It's a form that an insurance advisor has to fill in and get the client's signature on it. Basically, when we advise a client to cancel their existing policy and purchase a new one. Now, what are the most important things when somebody does this? We're going to say, okay, what are the advantages? The advantages are because your health is in a good standing, your premiums are lower. So that is why I suggest you to save money and purchase this new life insurance policy. What are the disadvantages? Now, because this is a new policy, you will have the 2-year suicide clause and the 2-year incontestability period. So if you commit suicide at age 51, because this is a new policy that you bought, it's not going to be covered. So in the LIRD form, you have to write down what are the advantages and what are the disadvantages of making this change. So remember, the only reason why that we might advise the client to give up their policy and get a new one is not because of our commission. It is because of the sake of the client, and they're going to get a better rate or better benefits. But the disadvantages that we are going to have the 2-year contestability and also the 2-year suicide clause as well. This is what renewable is. So remember that in the renewable, there's no 2-year suicide at age 50 in this case. But if we reapply for a new insurance policy, obviously there is going to. Let's talk about convertible. So convertible means that after I have this term insurance, I could convert it to a permanent policy. This is really important at the time that we talked about it. One of the reasons why people get term insurance is because of low budget, right? Limited cash flow. So they can't purchase a permanent policy at that time, but they know that in the future things are going to get better, and they know that they need a permanent policy. Their needs are not actually going to expire. So we give them a term 20, which is going to be cheaper, but with the guarantee that, hey, you can actually convert it to a term policy. To a permanent policy. So in this case, again, the medical insurability and everything, it's completely guaranteed. So it's going to be more expensive. Actually, I'm going to tell you guys this. A convertible policy is the most expensive policy out there. Why? Because they're guaranteeing you, based on your health, that, hey, if at age 50, 60, 70, you want to convert it to a permanent policy and you're terminally ill, we're still going to do that. So they're possessing a lot of risk. It's not now only renewing it for another 20 years, because the term insurance eventually is going to expire, either at age 80 or 85, usually. But a convertible policy means that, hey, this is going to go all the way till whenever you pass away. So I'm insuring you and guaranteeing that insurability. Again, it's not going to have the 2-year suicide clause. It's not going to have the 2-year disability clause when you convert it. And the prices are based on the attained age that the convert is going to happen. And that is what a convertible policy is. So price-wise, increasing is more expensive than level and more expensive than decreasing. And convertible is more expensive than renewable and more expensive than non-renewable. Let's look into a couple of questions, and then we'll end this video, this session. The next session and next video will be on the way. So Scarlett and Johnson currently have no insurance coverage and are meeting with an insurance agent for the first time. They are looking for a recommendation that will help them meet all their insurance needs. They currently have a mortgage of $540,000, which will be paid off in 25 years. Johnson also has a rental property from his previous marriage that has a mortgage of $135,000, which will be paid off in 10 years. The couple's agent explains the different insurance types, and they need to decide on the options. Which policies would best meet all their needs? Now, this is really important because a lot of times there might be more than right answer, okay, and the options. But we have to look into see which one is the best option for our clients. Let's look at option A. So first of all, we know that Scarlett and Johnson, they have a $514,000 mortgage together. And Johnson separately has another $135,000 of mortgage. This is basically the needs that they're telling us. This is going to take 25 years, and this is going to take 10 years to be paid off. So obviously, they need a term insurance, right? Now, let's look at option A. Option A is saying that, okay, Scarlett is basically only responsible for that $514,000 mortgage, right? So we can give her a term 25, a T25, that means for 25 years of $514,000. So if Scarlett passes away in the next 25 years, there is a $514,000 paid out to pay off the mortgage. And it's $649,000 for Johnson, which makes sense because 514 plus $135,000 of mortgage, we're talking about $649,000. So if Johnson passes away in the next 25 years, both mortgages are going to be paid off. If actually John passes in the last 10 years or the last 15 years after the $135,000 mortgage has been paid off, the family is actually going to have a little bit more money in their hand as well. So this option is covering their needs, but is it the best option or not? Let's look at the next answer. B, mortgage insurance term of $514 for Scarlett and a mortgage insurance term of $649,000 for Johnson. So this one is protecting the life of the mortgage, right? It's not protecting their life. And mortgage insurances tend to be post-claim underwriting. So the underwriting will be done after the client passes away. That is why we don't really recommend it, okay? They might change the lender of the insurance, of the mortgage. And based on that, then the entire insurance is going to be changed as well. Let's look at option C. Participating whole life of $100,000 for Scarlett and Johnson and joint first to die term for $649,000 for Johnson. Well, why should we do this? They don't have any permanent needs right now. So purchasing a whole life policy, which is a permanent policy, would only increase in their prices. What we're seeing is that option A, B, and C, all three might be covering the needs. Actually, option C is not. But because if Scarlett passes away, they only have $100,000. But even though it's a little bit too expensive for what they need, let's look at option 4, D. Joint first to die term 25 of $514,000. So if one of them passes away, the other one will get $514,000 to take care of that mortgage. And also a term 10 of $135,000 for Johnson. So if Johnson passes away in the next 10 years, the $135,000 will be paid out. So this is a much more better option, a much more suitable option, cost effective for Johnson and Scarlett. So even though that like option A was good as well, but option A was doubling the amount of coverage that they need because they would only need one $514,000 if one of them passes away. So the correct answer is D, right? Let's go to another question. Alden is a travel blogger who visits different countries on a regular basis. During days when he doesn't travel, he engages himself in adventurous sports like surfing and skiing. He received 3 tickets in the last 2 years for speeding on highways. He consumes alcohol but never smokes. Which of the following might cause Alden to receive a rated policy? So remember, we have the standard with exclusion, and then we have a rated policy, which means that it's going to increase, which means that we can't exclude that risk from other indicators of mortality risk. So what are the things actually? One of them is the adventurous sports. The other one is actually visiting different countries. The tickets that he got for speeding, consuming alcohol, but doesn't smoke. So doesn't smoke is something really good. Now, the insurance company can say, Alden, I'm going to cover you for any cause of death, but if you die in these specific countries, I'm not going to cover you. So visiting different countries could actually be an exclusion. Adventurous sports are the same as well. They can say, Alden, I'm going to cover you for everything, except if you pass away during those adventurous sports. But the ticket is a lifestyle habit of speeding. And the insurance company cannot exclude it. Because what if they're actually driving really fast, but somebody else hits them? And because their speed was too high, the amount of damage was higher. So they might not be at fault, but because of the high speed, the fatality rate is going to go higher. It's basically showing a careless lifestyle. And also consuming alcohol might affect different organs of the body. So you can't exclude that one as well. So the right answer is going to be A. Only the driving record and the alcohol consumption are the ones that are rated. Let's look at another question, which we did talk about it actually. So based on her life insurance agent's advice, Margaret has replaced her existing term life insurance just before its renewal with new term insurance. The coverage of the new policy is the same and the premium is lower than what it would have been if she had renewed her policy first. So her first policy. So basically, the insurance advisor advised Margaret, hey, go and get a new policy. Why? Because it's going to be cheaper. The coverage is the same. In addition to the life insurance replacement declaration, the LIRD, Margaret's life insurance agent gave her a written explanation specifying the reasons behind her policy replacement. The agent included that the new policy would cost Margaret less and that the new policy is contestable for the first 2 years in the event of material misrepresentation. So the benefit is that it costs less, but the disadvantage is that it's still going to have that 2-year contestability and also suicide clause as well, which wasn't mentioned in this question. So what other information needs to be included in the written explanation that accompanies the life insurance replacement declaration form? Basically, I gave you the answer. It is the exclusions under the new policy that we have to definitely write down in the LIRD. And we'll talk about the additional information. So obviously the other ones are already there. And last question. Winnie applies for a $500,000 whole life insurance policy on her life and is awaiting approval. She had mentioned the family history of heart disease and her recent visit to the doctor for experiencing sudden breathlessness in her application. Which of the following is the underwriter most likely to request while analyzing Winnie's application? So this is basically a question from, I would say, understanding insurance that I talked about the different ways that the underwriter will, assess the medical health situation of the client. And for this one, they have a family history of heart disease and there's a recent visit to the doctor. So definitely they want to get an APS from the doctor to make sure that everything is okay. Now, this was all about what the definition of insurance is, how the insurance premiums are calculated, and obviously we talked about term insurance. Next video, we're going to talk about the permanent policies. We're going to learn what they are, how they work, what are their key benefits, and we'll take it from there. So thank you so much for following us till now.